Hi, my name is Alec. I am one of the investment managers for abrdn China investment company. I work alongside Nicholas Yeo and Elizabeth Quick. The objective of the trust is to invest in high quality companies listed in China based on a bottom-up research approach. Overall economic recovery in China was slower than market expected initially. While market was expecting a V-shaped recovery, the actual recovery was actually rather steady and uneven. We've seen some recovery in service consumptions, but manufacturing and investment recovery has been quite slow. But it's worth noting that unlike developed economies, China hadn't relied on broad-based handouts to spur consumption, and therefore the expectation that China will see a similar V-shaped post-COVID recovery such as the ones we've seen in developed economies was too optimistic, and that resulted in a retreat in consumer stocks in the second quarter. The government is recognizing the need to support the economy. In fact, at the latest Politburo meeting in July, the government signaled efforts to boost the consumption, support housing demand, improve capital markets, and restore private sector confidence and investments. It's worth to note that the governments this time around changed the tone towards the property sector, as they didn't mention the overarching policy framework towards the property sector, which is housing is for living, not for speculation. And they also pointed out the need to adapt to changes in demand and supply in the sector. We expect on the back of this meeting, more supportive and specific policy measures. And we think those will likely be calibrated towards specific sectors such as autos, electronics, household products, and property. Now, what does this mean for earnings? We think depending on the pace and strength of the support measures, we could see a bottoming of downward earnings revision later this year, potentially in the third quarter. Coupled with the supportive government policies, keep in mind that the valuation is at extremely undemanding levels, which offers great opportunities for long-term investors like us to buy quality assets at very attractive price. This is a ripe opportunity to get back into the Chinese market before sustained recovery momentum takes off and before the markets rebound strongly. China's growth target for 2023 is around 5%, which is in fact higher than expected growth rate for most large economies. To put things in context, the global growth rate outlook projected by IMF for 2023 is 3%, which is down from an estimated 3.5% in 2022. Over the long term, China will continue to have an outsized presence on global economy, accounting for at least a third of global growth. There's also a concentrated push from the Chinese government to build out a critical domestic sectors such as green energy, technology, and digital economy to attain self-sufficiency. And these are the areas where we find a lot of structural growth opportunities. And therefore, despite the near-term challenges and volatility, we continue to believe China is a promising market to invest in. Thank you for your interest. And to find out more information about our fund, please visit our website or click the link below.